Good morning from London. I'm Anna Edwards alongside Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. European futures set for a weak open as investors trim positions heading into year-end. European energy is in focus this week with just 24 hours until a key gas transit deal between Moscow and Kyiv is set to expire. And former US President Jimmy Carter dies at the age of 100. January 9th has been designated a national day of mourning. We look back at his dramatic term in office and his humanitarian legacy.
In the meantime, a quick check on these markets. We'll bring them to you in a moment. We are seeing kind of a risk-off sentiment right now in futures, down about 0.2% of the Euro Stoxx 50 futures. FTSE 100 down, playing that same tune, down about 0.3%. 460 though on that 10-year yield. We are on inflation watch going into January, and of course, euro dollar at a 104. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. Monday, the 30th of December. For some parts of the world, this will be the last trading day of the year. For others, we still have either a full trading day or a partial trading day tomorrow. But perhaps, Kriti, let's put aside some of the market news for the moment and go to our top story this morning, which comes to us from the United States, of course. The 39th US President, Jimmy Carter, dying at his home at the age of 100. He was president, as we know, from 1977 to 1981. And we will bring a fuller report on his legacy and what he was doing after he was president, because there was a lot he did in that period. We'll bring a fuller report on that later on. But what struck us as interesting was talking about the number of ways in which the agenda items that he was dealing with day to day and had an impact on, they're still with us. And so his legacy very much still in the news today.
Yeah, 40 years and counting have passed. And yet, to your point, it's the same conversation. It's Iran, it's what's going on in Israel and Egypt. And of course, it's Russia and how you deal with that. He was famous for boycotting the Moscow Olympics in 1980 because of the very same concerns that you have around today in terms of kind of Russia's influence in surrounding areas via the Middle East. Wars, of course, now in two regions, but at the time we're also dealing with war in the Middle East as well. And on top of that, he was the one who was dealing with very high inflation, high living costs, bringing Volcker to the table, which we, of course, know has a lasting legacy as well.
Yeah, on the economic front then, high inflation up to 13%. Volcker appointed, as you say, to bring in his monetary policy stance and then triggering perhaps recession, oil shortages. You've mentioned Iran. So the 1970s and the inflation conversation has never been far away from what we've been talking about, even if the comparisons are really imperfect, what we've been talking about in recent years. And then on the more geopolitical stage, really fascinating to see the President-elect Trump talking about Panama quite so much when it was under Jimmy Carter that we saw the US-built canal handed back to Panama. So lots of ways in which the agenda items he was dealing with are very much still with us.
I mean, the fact that trade is still such a key piece, and of course that energy conversation, which isn't just one that's talking about in the United States, it's right here in Europe as well. We are, I believe, 24 hours away from a gas transit deal between Moscow via Ukraine into several European countries as well, expiring. The Slovak Prime Minister Robert Fico had a lot to say on that, really talking about just how much it would cost for if these kind of gas pipeline was halted, these gas flows were halted, talking about something like 40 to 50 billion euros in costs for European businesses and households relative to just 2 billion annually for Russia. And he's really kind of trying to get Ursula von der Leyen and other governments involved as well.
Yeah, he wants the European Commission to take some action. Now, the European Commission has been reluctant to because they want to emphasise the fact that Europe is moving away from any reliance on Russian energy. And, of course, there are still these flows going through Ukraine quite unbelievably. But Europe wants to wean itself entirely off this Russian gas by 2027. And so that's the focus for the European Commission. So whilst the Slovakians can argue that they want more help from the Commission to dull the impact of this or to change views in Ukraine, it doesn't look as if that's going to happen, at least at the moment, because the European Commission putting the emphasis on, well, you need to find alternative sources of energy, and that perhaps a message to parts of Eastern Europe, including to Slovakia. Interesting that Slovakia then said that they would cut off electricity to Ukraine, and Poland has had to step in and say, well, we will try to make up any shortfall in terms of electricity provision.
Yeah, that trade-off between the inflationary pressures and the business pressures versus kind of these national security conversations as well. Crucial. I wondered, see if maybe it shows up in the market trade today.
Yeah, absolutely. Let's think about where we head, because it is either the last trading day of the year in some geographies, or it is the penultimate trading day of the year. But stocks have had a really good year in 2024. Not all assets have had a really good year, but stocks certainly had a decent one. Well, US stocks in particular, and those that were very driven by AI excitement and big tech and the mega cap technology stocks we know well, they did pretty well. And momentum was one of the strategies that also did really well. Interesting reporting by our colleagues talking about this strategy of buying winners and selling losers. The momentum trade, as it's known, up by 31% in 2024. And that's not a bad record. It's set for the best year in 2 decades, Kriti, at a time when we're asking a lot of questions about whether momentum remains a good strategy into 2025.
Yeah, momentum, of course, intertwined with that tech trade, of course, in the States, the Mag 7, a key feature of that. But then also the small caps as well, and a lot of that benefiting from the Trump trade, the idea of deregulation, the idea of the Fed kind of cutting rates as well, all of that to benefit the small cap story. But you're 100% right that this is where I feel like we have this conversation every year on December 31st, that the valuation story in the U.S. stock market may not roll over into 2025.
Yeah, and there were a lot of fears about what stocks would do in 2024, and they proved to be unfounded. I was looking back at some of our reporting, and it suggests that the highs that were predicted for the year were actually achieved in January of 2024. I don't know what we've been doing since, but that's been the story. Strong stocks over in the United States. With that in mind, and everything that's happening in markets as we bring this year to a close, we will be joined by a number of guests to have these market conversations. Jordan Rochester, EMEA head of FIC strategy at Mizuho, fixed income, currencies, commodities. We will talk to Jordan a little bit later on. There's been some movement around the yen in recent sessions and some headlines there, so we'll certainly get that into the mix. Salman Ahmed, global head of macro and strategic asset allocation at Fidelity, will also be with us. And we'll talk about the European banking sector as well. Simon Samuels, partner at Veritum Partners. Really interesting conversations about where interest rates go in 2025, where the regulatory impulse goes for that sector as well.
Yeah, I mean, it's going to be a good conversation to have going into the new year. And I feel like while we're all kind of maybe winding down for the year, there's still plenty going on in the week ahead as well. Let me just walk you through it. On Monday, we do kick it off with the Dallas Fed manufacturing activity and pending home sales. There's still some data that's going to hit the wire as well. On Tuesday, it is, of course, New Year's Eve. As Anna mentioned, some of the stock markets will not be open that day. We'll dive into which ones later. I believe Germany closed tomorrow as well as one to keep an eye on. Today's last trading day there. But you're going to get PMI data readings out of China on the last day of the year. And then, of course, Wednesday, I believe most major stock markets are closed. We certainly will not be on air on Wednesday, marking, of course, the new year. But then at Thursday, we are back to work. That manufacturing data from China and the United States are going to hit the wire. We really do care about this out of China, potentially tradable in the kind of trade conversation. And on Friday, we do get some comments from Richmond Fed President Thomas Barkin.
Yeah, so we do have some data points, don't we? That illustrates, not till the end of the week, really, for a lot of the US data, but there's jobless claims, and we'll get some manufacturing reading as well. And China PMI data, the beginning of the week, so tomorrow we'll wait for that. And then, of course, we'll remember not to be here on Wednesday, Kriti.
Yeah, I feel like we may actually both just end up here and then find out that maybe we don't have programming, and then we'll have to be refreshed for Thursday. Let's get to some of the other things we need to know this morning. There are plenty going on around the world. South Korea is conducting special inspections of Boeing 737-800 planes operating in the country until January 3rd after Sunday's JEJU Airlines crash. 179 people were killed, making the accident the deadliest passenger airline disaster in South Korea's history. Investigators are focusing on a bird strike and unusual landing gear failure in the final moments of the fateful flight. Croatian President Zoran Milanovic won Sunday's first round of the presidential election with 49.1% of the vote. He's a favorite to win a runoff on January 12th. The populist leader opposes NATO expansion and has condemned military aid to Ukraine. A Milanovic victory would add to recent wins in Eastern Europe for politicians with sympathies for the Kremlin. And Elon Musk has reiterated his support for Germany's far-right AfD party. In a newspaper opinion piece published over the weekend, the world's richest person said the party represents a political realism that resonates with many Germans who feel their concerns are ignored by the establishment. Musk has extensive business interests in Germany, including a Tesla factory near Berlin. And we should mention as well that, of course, Elon Musk is also the owner of Starlink, which offers a lot of military assistance to Ukraine. and has been a point of contention from some of the U.S. government and defense contracts.
Yeah, and our colleagues writing a big take story around Elon Musk and Starlink in particular just over the last 24 hours, which is really interesting, talking about how the barriers to expanding Starlink and the barriers that certain governments have put in the way of its expansion have been coming down, at least at the margin, partly because of the increased role that Elon Musk is playing in U.S. politics. You can't argue that he doesn't have a seat at the table. He has a seat at the U.S. decision-making table, and that seems to be something that is proving to be quite convincing, from South Africa, arguably, to Indonesia, to the Philippines, and our story sort of goes around the globe, crafting ways in which barriers to him and his Starlink empire are coming down. It's really interesting to think about what his intervention means over the weekend, because this just sparks, it's just the latest in a string of conversations about the role that he plays in European politics, the extent to which he feels able to give everybody his views on European politics, the extent to which that is welcome or not, and that will no doubt depend on people's individual views.
And he already burned some bridges over at the EU, for example, and several other European leaders when he acquired Twitter, and he talked about election interference there, and now earning the ire of Friedrich Merz as well, basically saying this is foreign interference, which, of course, the United States has very publicly said they're not in favor of, and then here you have Elon Musk commenting on politics of other countries.
Yeah, and there's an ongoing debate about financing for UK political parties in Britain, the extent to which, there are rules about foreign nationals not being able to contribute, but those who have business interests in the UK can contribute. Should there be limits on the scale of that contribution? That's certainly an ongoing conversation, and what role Elon Musk plays there, because, of course, he is somebody who's spoken out very favourably in support of the right here in the UK as well, in the form of the Reform Party. Let us pivot from European politics then back to the United States. The former US President Jimmy Carter has died at the age of 100 at his home in Plains, Georgia. His term in the White House was marked by significant achievements, including brokering a peace accord between Israel and Egypt, as well as economic turmoil at home. Bloomberg's David Weston takes a look back at his life.
President Carter came to office in the wake of Watergate and Vietnam with a commitment to right the ship of state.
President Carter brought back to government honesty, integrity, and faith in government. He ran as a candidate on a government as good as its people, and he truly did deliver that.
I think President Carter in many ways was ahead of his time in terms of his emphasis, for example, on human rights, in terms of his thinking about alternative energy, in terms of his role in the Middle East peace agreements that he put together. And we all know that his ex-presidency, which has been such a long one, has been graced by remarkable contributions to humanity by former President Carter. I think right now, he is seen very favorably. I'm really happy to see that, because he's a very special man.
One of President Carter's biggest challenges was energy in the face of the second Arab oil embargo.
Well, he was president during a very challenging time. As you recall, there was the oil embargo, which drove oil prices up dramatically. That became a catalyst for the highest inflation that we had really since the war, and probably even before that. And so he had to take some very tough fiscal measures. He did appoint Paul Volcker, who, by very much tightening monetary policy, caused a recession, which certainly was not an easy thing for President Carter to run through.
He was the first person to talk about energy and how we had to start looking at renewable energy plans and how our country could invest and incentivize in that area. And I don't know if you remember, but he had a solar panel on the White House, which when he left, President Reagan took down. But he also had fuel mileage standards and, really realized, I think, way before anybody else, that we had to start thinking about what climate and what it was doing to our planet.
But as influential as Jimmy Carter was as president, he will be remembered every bit as much for what he did after he left office.
The thing, though, that I think is absolutely most notable about President Carter is we can all debate the relative merits of any individual president's term, but I think it's inarguable that President Carter is the single most impressive, most successful, and most to be admired ex-president in the history of our nation. This is a man who took the responsibilities of being a visible public figure incredibly seriously and was a role model to all of us.
Welcome back to the programme. This is the opening trade. It is Monday, the 30th of December. Welcome back to it. This is the picture for European equity market futures right now. Looks as if we will see a little bit of weakness. We had a weaker session in the United States following the closure of markets here in Europe on Friday, and so we have that to inherit. Let us go to the global conversations that have been running towards the latter part of this year, and no doubt we will pick up next year. And one of those involves global trade and the risks of trade war. We see that the ECB's Klaas Knot, Governing Council member Knot, has been talking to the Volkskrant newspaper over in the Netherlands and talks about the chance of a trade war being serious, saying China may send cheap goods to the EU if the US imposes tariffs, and China could export its deflation to Europe. Let's put that to our next guest, Jordan Rochester, head of macro strategy at Mizuho EMEA, with us on set this morning. Jordan, very nice to see you. Thank you for coming to join us so close to year end. Let's talk about some of these lines coming out of Klaas Knot then, because it really does give us another way into that conversation about the trade war, the extent to which we might see a trade war causing inflation in the United States, but deflation here in Europe via that China link. Do you agree?
I absolutely agree. So it's definitely deflationary for Europe and for the UK especially, because what's going to happen is if we have tariffs locked onto China, let's say Trump goes for the 60% tariff that he floated during the campaign, those goods are going to be less competitive in America and appear more cheap to European consumers, who the Chinese will happily push it towards. It takes less time to get to Europe as well. The most important one for me is that the Europeans might raise tariffs on China if it continues to flood their market. The UK probably won't. And the interesting thing about UK and US, so of those Chinese goods that go to America, the UK has the highest similarity score of imports from China to the US. So a lot of those goods will actually flood the UK market. So the UK is the one where everyone says inflation is going to be quite sticky. Europe is the one where inflation is going to be quite low. The narrative might change quite quickly if those Chinese goods make their way to the UK.
That's interesting. I mean, some consumers will like the idea of lower prices and if goods are cheaper from China. Why do you make that distinction between the UK and the rest of Europe then? Why do you say that the rest of Europe might respond with tariffs, but the UK won't?
Stroll down to Mayfair, as I'm sure you always do. There's a BYD lounge there. You can go sit in a BYD car from China. Now, the UK hasn't raised tariffs on Chinese vehicles in the same way that the Europeans did. So that reflex for protectionism is stronger amongst the Europeans than the UK. So I think the view is that it's deflationary for Europe and the UK, but the UK will be the one that stands out in the end.
When it comes to those trade flows, though, I mean, we're talking about this in the context of Europe, but Europe is also talking about trade with the United States and closing some of that deficit as well. We know Ursula von der Leyen has already made this opening offer of LNG as well. Is that enough to affect the FX trade or even the bond trade at all, or is that just still kind of cloudy?
No, it's a big piece of news. So let's go with the FX first, and then we'll do the rates. So on the LNG, the US did a sort of mini deal with Europe in 2018. Now, Juncker was in charge back then. It wasn't Ursula von der Leyen. And it was a bit of a political charade because the EU can't sign trade deals that forces European countries to buy LNG from America. But that's what actually happened because there was a lack of supply thanks to Russia-Ukraine. So now half of European imports of LNG come from America. So in 2018, it was a big win for Trump that. You actually saw a big pickup in LNG exports, and you saw the Europeans take up half of it. But we're starting now from that position, and Trump's not happy. The deficit with America has widened $41 billion between the US and America and Europe. So it's, to me, uncertain that you can do the same charade again because they're already buying half of the LNG and it's a global market.
What is the point of, sorry, I know you're going on to the other point, but what is the point of these charades then? If, you're not talking about the European Commission buying energy, that it doesn't do that. It's not its role. And even European countries don't. We're talking about private businesses in many parts responding to supply and demand dynamics and global pricing for LNG and other competitive fuels. So what is the point of those charades? Because your description suggests it had an impact there.
It had an impact because the US wasn't really exporting LNG at the time, and it's massively ramped up. It's going to ramp up again this year. And it was a political charade because that was Trump 1.0. He was surrounded by Mike Pence cabinet appointees. This time around, he's surrounded by MAGA appointees. So he'll be more aggressive and want more out of it. He'll want a proper deal. But bringing it to rates and FX, first impact, I said at the start of FX, it will help the US. The trade deficit will get slightly tighter on the back of it. It's dollar positive. It's a huge plus for US exports. We saw that in 2022. The terms of trade for America went through the roof. They are an exporter of oil and natural gas. Yeah. So when gas prices go up, they do well. And gas prices are going up. This is point 2 on the rates. This is where we could be wrong next year. I think inflation could rebound thanks to energy services in America rebounding, thanks to natural gas. And at the moment, we're seeing a big expansion in LNG this year of export production in America. We're going from around 10 to 14 million cubic feet is how they describe it. It's a big increase, 30-40% increase. But the US gas production isn't increasing that much. Yeah. We're seeing Henry Hub gas prices accelerate into year end, and that's going to feed through to stronger US CPI releases. So it means the Fed cuts by less, even though the Fed pricing is already quite low, and I think we could see a 5% handle on the 10-year.
So this is all dollar positive then. Inherently, that means weakness for Europe and weakness for the euro. Does that weakness in the euro attract capital flows from the rest of the world? Does that make Europe cheap to own? Cheap enough to own?
The word's cheap to own is cheap for a reason. Where's the growth? Where's the deregulation? Where's the positive sort of momentum?
What is that incentive, for example?
It's an incentive for sure. You'll see some M&A flows are picking up as well, so you'll see some deals go through. But I don't think when you've got Novo Nordisk selling off by 20% for a good reason, that you're going to see the markets change their mood music. You're going to still see US outperformance versus Europe, I think.
OK, and that's still... I was reading back the way that a lot of strategists were wrong about this year. They had low expectations, actually, for stocks, whereas we go into next year and a lot of strategists have
really
quite high expectations for next year. So things are a little bit different, Jordan. Do you think how does the year look as if it pans out to you? And does a lot depend on the order in which we get these policy initiatives from the Trump administration?
Absolutely, yeah. So I always love to ask the question how I could be wrong, because most of our trades are going quite well. It's usually January things all fall apart. Most of these outlooks that everyone puts a lot of effort into in December, they go on road shows, see lots of clients. By week 2 of January, they have to kind of rewrite them. We could be wrong if inflation really accelerates and then the Fed actually has to talk about raising rates. That's a scenario where stocks just don't work. We kind of need inflation to stay below 4% on a sort of annualized handle in the month-on-month prints. Then the stock market can handle it. Yeah. But if we have a 2022 dynamic pickup in energy, or if these tariffs are just more aggressive than we thought. So at the moment, the market's saying Trump's going to do tariffs, but it'll be staggered across a year. It won't be as large as he said. If he goes 60% with China instantly, if he goes 10%, 20% with Europe instantly, I don't think the stock market handles that very well.
Very quickly, I'm going to put you on the spot from U.S. politics to maybe European politics. What happens in the fallout of the German election? Is a removal of the debt brake viable, and how do you trade it?
I don't think it will be removed. I think it will be suspended again. I think it's possible they need to. So if the US really pushes on NATO spending, Germany won't be able to do that significant increase to support Ukraine if the US pulls its funding. So it doesn't add up. You need to suspend the debt brake. I'm optimistic, though, that you're going to have the tariffs from the US on Europe lead to substantial change in Europe. They need to get their act together. They need to put some form of a Draghi plan that they already have laid out for them. They need to implement some of those reforms. How many times Draghi has to say the words capital markets union and nothing gets done about it? I'd love to see a sort of crisis emerge where out of the ashes of that we see some positive reforms in Europe. So that we actually see euro recovering in the second half of next year thanks to the potential of that. But also all this monetary easing from the US, from Europe, China should see a bounce in growth.
Well, we'll see if that happens. Jordan Rochester, pleasure to have you on the program. Happy New Year.
Happy New Year.
Looking forward to having you back in 2025. The head of macro strategy there over at Mizuho, EMEA, joining us around the table. Coming up, we stick with that conversation in Europe. European leaders bracing for the impact of potential Trump tariffs, as well as that domestic political upheaval. We're going to dive into it. Stick with us. This is Bloomberg.
Welcome back to the programme. This is the opening trade. The futures picture for stocks in Europe looks negative. We are expecting to be down around 0.4%. Euro Stoxx 50 futures would indicate. And some of that is the handover from Friday's session in the United States, where after we'd made some decent gains during Friday's session, we saw weakness stateside, particularly on the NASDAQ, particularly on the Mag 7. But it was pretty broad. It was pretty widespread. Some of that selling towards the end of the year. So we go into Monday the 30th with fairly low expectations, it would seem. In terms of where we are on bond markets, then let's have a quick look as we have all of the news flow surrounding the bond markets in 2024 ringing in our ears. 3.2% is the yield on the French 10-year. 2.39 is the yield on the German 10-year then, Kriti.
And a lot of this comes down to the same issues, how this will happen in 2025, dealing with the kind of worries or laundry list of worries over in Europe. Let's dive into that. Low productivity and failure to invest led to vast amounts of lost growth in the EU. With France and Germany in political crisis, the continent risks more lost years of stagnation. Bloomberg Originals dove into it. Take a listen. The news for Europe just keeps getting worse.
The French government collapses, plunging EU's second largest economy into turmoil.
France's political upheaval in December offered another glimpse at fractious European affairs.
Germany's under pressure and Volkswagen workers are striking hard.
In my view, we are already in a crisis mode.
Our former model is over. If we follow our classical agenda, we will be out of the market, I have no doubt.
The EU's economy is now fighting for survival and struggling to keep pace with the US and China.
Had the European economy grown as fast as the American economy over the past couple of decades, we'd be generating 3 trillion euros of extra income every year.
That's roughly the equivalent to the total GDP of France being routinely added into the economy.
Europe needs to have a digital era economy with companies that challenge those from China and from the US.
Without that, the region's at risk of being unable to afford to protect itself in a world where security is no longer guaranteed.
It's just a very tense moment for the world, and Europe's at the center of it.
You can watch the full Bloomberg Originals documentary on YouTube and on our website as well. Let's get on to one of our other stories here. Elon Musk weighing in on European politics. The world's richest person has doubled down on his support for the far-right party Alternative for Germany, or AfD as we know it. It comes after German President Frank-Walter Steinmeier dissolved parliament and set the country's snap election for February, formally endorsing a timetable proposed by Chancellor Olaf Scholz. Let's bring in Bloomberg's Oliver Crook to discuss that story more. Ollie, walk us through what we know here.
Yeah, so listen, we got the first procedural marks now with Frank Walter Steinmeier, I should say, dissolving the Bundestag officially. And now we have the official election on February the 23rd. This has been widely expected. When you look at the polls going to this, not a huge amount has changed. We look at the CDU leading at 31%, and then coming in number 2, the AfD with 20%, about a fifth of the German vote, and then Scholz's party, in third place with 17%. Now, focus is coalescing more and more internationally on this question of the AfD, the Alternative for Deutschland, the right-wing party here in Germany that basically has been boycotted by the entire political establishment of Germany. No one will enter into a coalition with this party, which will make it very difficult, increasingly to build a government, just given the layout here, which is, of course, what led to the collapse in the first place. The reason that it's getting more international attention is because Elon Musk, not content to just be now a principal actor within the U.S. government, now a commentator on German politics, coming out and now actually putting out an opinion piece over the weekend in Welt, saying that the AfD, even though it is described as a far-right movement, represents a political realism that resonates with many Germans who feel their concerns are being ignored by the establishment. It addresses the problems of the day without the political correctness that often obscures the truth. And to just give you a feeling of why this is such a fraught issue here in Germany, the editor for the opinion pages of Welt resigned after this went to print. Obviously, this is a very charged issue, the far right within Germany. We heard Elon Musk in the past endorse the AfD, but also call Olaf Scholz a fool and really be very critical of bureaucracy within Germany. He has a Tesla factory not too far from here. But we also heard from Friedrich Merz, the person who's leading in the polls, the head of the CDU, who in an interview said, "I cannot remember a comparable case of interference in the election campaign of a friendly country in the history of Western democracies." And just to remind some of the these sort of policy proposals from the AfD, which is now polling in the second position here in Germany. Among them, and I think for our audience probably most critical, is that they want to exit the Eurozone and also the EU. And these are some of the issues that are going to be sort of bubbling up, making it a little bit more difficult, I suspect, to have a cohesive and coherent approach to EU policy going into 2025.
Yeah, the role of Elon Musk in US politics and politics much further afield, Ollie, will no doubt be a theme of 2025. We're thinking about the German election, of course, because it looms large on the calendar. It's going to take place in February. But instability in German politics is just one of the many issues, I suppose, facing Europe as we head into 2025. How does the landscape look for you?
Yeah, so listen, Anna, I mean, listen, we still have to get a French budget, right? We have sort of not really any good indication that that is going to happen anytime soon. You know, the collapse both of the German government and the French government were basically down to budgetary issues in large part. And so there's, you know, that big question of in a time when you have extremely low growth in Europe and you don't have that much money to play for, you know, that is going to cause huge political problems. And that is before we're even considering some of the other headwinds that we're going to get throughout the year. Of course, the election of President Donald Trump, what he's going to do with tariffs. You know, we had a little indication of that a couple of weeks ago, saying that, you know, if you buy more LNG, maybe you'll be okay on tariffs. But again, that is also always a very sort of fluid discussion that can always change at any moment. But also, it's not just an economic question. There is also the potential withdrawal from support of Ukraine. There is this question of course, Syria. You know, Trump has said that he basically wants zero involvement in Syria. Syria is a major issue for the Europeans, particularly through the lens and the prism of immigration, which has led to the rise of a lot more of these populist parties here in Germany and in other countries. The question is, if the United States is not going to take any part in reconstruction and trying to bring stability, can the Europeans do it alone? To say nothing of some of the election interference we've seen in Georgia, we've seen in Romania, to say nothing of undersea cables that are being cut every couple of weeks. You know, these are sort of some very serious, very large issues for the Europeans to deal with at a time when the core of Europe is basically crumbling. I think that the hope is that you can get a moment here of political stability in Germany. Maybe you get a stronger government, though, of course, there is still the recipe for a lot of dysfunction within this coalition building. But really trying to face these issues that Europe has to face. What is going to be the voice of Europe? Who is going to be the leader to take charge of this? To say nothing of the ambitious competitiveness agenda, which is basically going to be the animating force of this new commission. There are a lot of tough political compromises that need to be made to make any progress on any of these issues, whether it's the capital markets union or the banking union or NATO spending and sort of collective defense efforts. These are questions that need to be resolved by a strong EU, and that is not really what we have going into 2025.
Well, Ollie, we talk a lot about it from a political standpoint and a government standpoint. You talk to a lot of major corporates in Germany as well. How are they preparing for this kind of laundry list of worries that you just laid out?
Listen, I think that a lot of them feel very, very sort of disheartened by what they're hearing from sort of politicians across Germany, right? I mean, we were talking to the sort of lobby that represents the Mittelstand the other day, which is the SMEs of Germany. This accounts for basically 99% of companies within Germany. It's a huge source of employment, and it is really also where all of Germany's historic strengths come from, all these sort of hidden champions. These are tiny, tiny companies within Germany that have been operating really since the 1800s that are the best in the world at something. And these, across the board, you look at the surveys within the Mittelstand, within the SMEs, within the big businesses, there is really nothing but doom and gloom and pessimism. And I think some of the frustration that you hear from a lot of the corporate world is that there is not a sort of consciousness here in Germany, maybe among the population, but also across the politicians, of the scale of what needs to change here. It's not just going to be enough to cut taxes here and there and to go, you know, slightly here and there on sort of some fiscal issues. What some people want is a real sort of reform, to talk about the debt brake, to talk about spending, to really grasp the moment in order to not let this sort of stagnation fall into a recession and something much larger. Of course, some of these issues are out of the control of some of the politicians, the slowdown in China, the tariffs from the United States. But really, you know, you need to think about where the engines of growth are going to be for these companies that are really, really struggling at the moment.
Ollie, thanks very much. Bloomberg's Oliver Crook in Berlin with a look ahead to some of the issues that no doubt will dominate European politics as we go through 2025. Well, one of the key issues that still manages to divide European politicians is where we get energy from. A key gas transit deal between Moscow and Kyiv is set to expire tomorrow, meaning billions of cubic meters in gas flows into the European Union. Well, they could be halted. Ukraine is under mounting pressure from Slovakia to keep gas moving from its Russian border, from its eastern border with Russia. Bloomberg senior reporter Henry Mayer joins us now. Henry, so what are the possible compromises and how serious would it be if we saw a failure to reach any kind of agreement here, because we still, years after the invasion of Ukraine, still have Russian gas flowing through Ukraine to parts of Europe?
Yeah, that's right. I mean, of course, negotiations will continue right up until the last minute. There are a few possibilities which have been put out there which could resolve this standoff. One would be for the European buyers of this Russian gas to take ownership of the gas as it crosses into Ukraine, which would fulfill Ukraine's condition of not having Russian gas transit its borders. That's one possible solution. Another one that's also been discussed is for these countries to buy gas from Azerbaijan under a swap arrangement whereby Russia would then sell its own gas to Azerbaijan. At this stage, of course, I mean, we're running out of time and it's not at all clear that they will be able to actually come to an agreement in time. In terms of the consequences, I mean, of course, Europe has managed to reduce its dependence on Russian gas significantly. I mean, prior to Russia's invasion of Ukraine in 2022, around 40% of EU gas imports came from Russia. Well, now that figure is actually via pipeline is down to 8%. If you include LNG, it's around 15%. But the loss of this gas pipeline route would, of course, bring that level down significantly and would have very significant consequences for those two countries in particular. I think gas prices have largely factored in this scenario, but still, this would be a major development, clearly.
Well, so let's stick with the Ukrainian story then and talk about that standpoint, especially going into 2025. You have Donald Trump on the campaign trail kind of bragging about how he plans on bringing a ceasefire between Ukraine and Russia. You have Emmanuel Macron, Olaf Scholz trying to broker some agreements as well. How likely is it that we actually get a stop to the fighting in 2025?
Well, it's clearly not going to happen instantly or even quickly. I mean, Trump's statements about ending the war in 24 hours are, frankly, nonsensical. What we have at the moment is a situation where Russia is continuing to make progress on the battlefield. Very slow, very grinding progress. It's costing them a lot of casualties, more than 1,000 a day. But, they have the initiative. At the same time, you see that Ukraine, which managed to capture territory inside Russia in the Kursk region, is steadily losing that. It was hoping to use it as a bargaining chip. So, Russia's position is, we're winning at the moment. We're not going to stop fighting until we get everything we want. And that's not only control of the territory which they have occupied, they have other conditions. Two main ones. One, they want Ukraine to give up its bid to join NATO, and they want to agree to very strict limits on the size of its military. Those talks will begin, I am sure, in the new year, but they are going to take some time and involve some very tough bargaining.
And away from the rhetoric and possibly including it, Henry, what do we really know about the way that President-elect Trump would like to bring peace to Ukraine? Because he's talked often about wanting to do that, and you've set out there some of the things that Russia wants to see if there is to be any kind of deal agreed. What do we know about what President Trump wants to see here?
Right. I mean, you have to look at what his advisors have said, key people in his new administration. So the Vice President, J.D. Vance, said in an interview a few months ago that he anticipated Russia would be able to keep the territory it currently occupies. He also mentioned the issue of NATO membership for Ukraine, that would have to be pretty much put, shelved, essentially. So, I think that Trump is probably willing to go quite a way towards meeting Russia's demands. I personally think that, limiting the size of the Ukrainian military is going to be a very, very difficult issue because I think Trump's position is going to be that he wants Ukraine to actually be in a position to defend itself against further Russian aggression. He doesn't want the US to have that job, and he's not going to be giving any kind of security guarantees, that's for certain. So he's going to want to make sure that Ukraine has that military capacity. So whether Putin will agree to that or not, I think think that's the big question.
We'll certainly see how this all unfolds, especially as, of course, European leaders vie for a seat at those tables as well. Bloomberg senior reporter Henry Meyer joining us this morning to make sense of the news. We thank you so much. Coming up on the program, we're going to dive into the markets as well. U.S. markets reaching new records in 2024. There's a year ahead have in store. The stock market, the bond market, the FX market. We'll dive into all of it. Stick with us. This is Bloomberg.
Welcome back to the opening trade. It is Monday, the 30th of December, the last trading day of the year for some markets, but not for most. For most, we have another day to go. But this is the picture right now for European futures, expecting to take a little bit of a leg lower at the start of European trade. Joining us now to talk about the markets in 3 minutes, Bloomberg Executive Editor for Asian Markets, Paul Dobson. And Paul, nice to take stock, I suppose, of the year and look ahead a little bit. We'll probably spend a lot of this week doing that. In terms of what we're seeing in today's markets, I understand we're seeing some of those that have done well, losing ground. I mean, is that just entirely normal as we've seen stocks make gains that investors sort of try and draw a line in the sand at the end of the year?
Good morning, Anna. Yes, I think that's right. I think that it's hard to read too much into today's and indeed this week's markets developments, other than that people will be repositioning when we get to the end of the year. So we saw a pretty sharp drop, a sell-off at the end of the day on Friday in US markets. That's carried through into Asia as well, led by tech. So it's this idea that the biggest performers, those that gained most, are seeing people either take some profits, lighten up their positioning, or rebalancing their portfolios as we get towards the end of the year. Likewise, we've seen crypto running out of momentum in recent days. Bitcoin didn't do particularly well over the weekend either. Some of the underperformers in the world's markets, that of Korea, for example, having a better day today, some outperformance there, even with some political news and the airline crash in their case hanging over those markets as well. So it's that idea that there's a little bit of that kind of rebalancing going on here. What it does suggest is that the momentum trade that people have been paying a lot of attention to, that's been really profitable this year, particularly across equities, but in various other spheres as well, is starting to wobble a little bit as well. People have enjoyed following those trends. A couple of times in recent weeks, we've had setbacks, which are maybe causing people to lose a little bit of confidence, but also then this idea that those companies and those markets that have underperformed this year, if you flip those positions going into next year, then maybe that's going to look a little bit more profitable for you as well.
Paul, let's talk about the bond market here. I'm looking at a 10-year at 4.59. January 1st of this year, I didn't think I'd end the year closer to 5% than 4% on the 10-year. Do we stay at these levels in 2025?
Yeah, hi there, Kriti. Yeah, so interestingly, in that treasuries market, we're now looking, kind of like there'll be no gains basically for buy and hold investors throughout this year, or very minimal ones. That's partly been due to that greater sell-off, particularly in the long end of the market. Think back to the start of the year. We were already priced for very aggressive Fed cuts. They didn't really come through very early in the year, and when they did come, yes, we had 150 basis point move, but that's kind of petered out as well. Now people looking forward to next year, people are worried the Fed might stop cutting, might go onto a pause, a plateau, may even start to raise interest rates, particularly as everything that we're going to be thinking about next year will be about Donald Trump policies, what it means for supply in the treasuries market, what it means for inflation outlook as well. If it is more inflationary, it could be bearish for treasuries, and therefore people are starting to think about the possibility that yes, it could be another year of higher yields, and also with a steeper yield curve if we do get those inflationary impulses coming through into the long end of the market. So that's something that people are watching out for, US specific, and I think globally as well, people are a little bit worried, thinking about, Japan. Okay, we're going to see another BOJ hike at some point. That's going to weigh on that anchor for global markets. So it could be a nosebleed year for bond markets again.
OK, and thinking further about the year and the turn of the year then, Paul, when you look back at where we've been through 2024, I mean, what really mattered to you? That one of the narratives or one of the dynamics that stands out to me is the way that we went into 2024, having high expectations of rate cuts. We didn't get those. We didn't get anywhere near as many as we thought we would, and yet stocks did really well regardless.
Yeah, so that's interesting, isn't it? Because for all that the bond market struggled to gain any momentum throughout the year, struggled to give investors any positive returns, at least in the investment grade space and in the government bond space, we did see that stronger performance in equities, that stronger performance in high yield as well, for that matter. I think there's two things that explain that, right? One is the outperformance of tech and new economy stocks that kind of bet on the future, as it were. And two, the Trump trade, which really kind of befuddled everybody and everything in global markets. It meant that rather than having a risk-on, risk-off dynamic where bonds and stocks are performing in opposite directions, which we've seen for a lot of the year, all of a sudden, we had that moment where we had that stocks putting in their excellent rally, and we did have the re-engagement of a little bit of underperformance in bonds, which hadn't been the case for much of the year. So shifting dynamics throughout the year, when we end up where all things are boiled down, much better year for people that had bought stock indexes and just held on to them rather than worrying about the trends and steered clear of the bond markets.
Yeah. All right. Bloomberg Executive Editor for Asia Markets, Paul Dobson. We're not going to let you go just yet, but thank you so much for joining us. We'll see you right here tomorrow at the same time. And as Paul was talking about, a lot of, I think he used the word befuddling in terms of
technical term.
In terms of what Trump's kind of policy may mean for the rest of the world. At the same time, we got a similar sentiment from the ECB's Klaus Knot this morning, saying that there is a very good chance of a trade war and that we may see deflation coming from China.
Yeah, and you wonder what order these policy initiatives come in from Trump. And you also wonder in what ways the globe responds, because whether we end up in a trade war is partly in the hands of the US, but might be also in the hands of those who need to respond to US policy. Coming up on the programme then, we'll bring you the market open. Futures are pointing a little bit lower for European stocks. This is Bloomberg. Welcome back, everybody. A few minutes to go then until the opening trade here for this Monday morning here in Europe. Let's cast our minds back to Friday and see what that has in store for us in terms of that handover from the US equity session. This was the European session on Friday, making decent gains, actually, during the European session for European equity markets and coming to a close near session highs or at session highs. But then we saw the US equity markets opening up and actually opening down quite substantially and then managing to maintain some of that negativity through the session. As a result of that, we see expectations reduced then for what we see this morning, Kriti. And we saw that momentum trades, of course, have been really big news in 2024 and a bit of unwinding of some of those momentum trades during Friday's session. Tech in particular, the Mag 7 and those tech stocks under considerable pressure during Friday's session. They've already come a long way and perhaps a lot of people trying to lock in any gains as we get towards the end of the year. And so with that questioning of those momentum trades, we saw a retreat in US stocks. Now, the extent to which that is translatable into Europe is debatable, because, of course, we haven't seen quite so much momentum to the upside in European stocks in tech or other places.
Yeah, certainly something we're seeing reflected in futures, that retreat that you were just talking about. It might also simply be people are taking cash off the table. Light volume, light liquidity seems to be the trend. When you are looking at the futures picture, Eurostoxx 50 futures down 0.2%, of course, indicating kind of a negative open there, but perhaps not by the same margin you're going to see on the continent. The FTSE 100 down by about 0.3%. A similar story over in France as well, and even in Germany. I will also warn, we are seconds away from getting Spanish CPI. That's expected to tick a little bit higher. We'll see if that's reflected in the equity open, Anna.
Yes, we'll certainly keep an eye on that Spanish CPI print. Is that going to tick up a little? And that does seem to be one of the warning signs that we're seeing from a number of geographies about that difficult, hard last mile when it comes to inflation. So the opening trade then for this Monday morning, the 30th of December, not quite there yet, not quite at the end of the year for most geographies. We are only seeing the FTSE 100 open so far, and it's down by 0.2%, waiting for the other constituent parts of the Stock 600 to get underway. But we do see a little bit of this down drift then, Kriti, as we perhaps had anticipated. The extent to which we read that US weakness from Friday into the European session, debatable, given we don't have quite the same tech read across into European markets. I see the CAC is now open, and that's opened down by 0.4%. 0.5%. Weakness on the IBEX over in Spain, down by around 0.5%. Now, it's interesting that for some markets, in fact, for most of those markets that I've just mentioned, we have another trading day to go tomorrow, at least in part. But for some of the markets in Europe, this will be the last trading day. Germany, some of the Nordic markets, Switzerland, this is the last trading day of the year. And so we will see where the DAX opens when it eventually does, Kriti.
It certainly is something we're going to keep an eye on because it closed higher in positive territory on Friday, higher by 0.7%. We are still waiting, as Anna mentioned, for some of that to open. In terms of the Stock 600, though, your early movers seem to be some of your winners of Friday as well, and that speaks to a lot of the likes of SAP, for example, your tech story, a lot of the commodity names, Total, Shell, which also really reminds me of the gas story as well. Anna, of course, as we are in the last 24 hours before that gas transit deal expires between Moscow and Kyiv, we may actually see that reflected in some of the most gas-exposed stocks. So Shell, Total, as I mentioned, some of the other commodity names as well that are really weighing on the index as a whole. But then you also have the likes of tech taking a little bit of a back foot there. But net, you can see it red on your screen across the board, and that's where we're seeing some pain.
Yeah, absolutely. So red across the screen, as you point out there, Kriti. Let's have a quick word on the Spanish CPI number. The harmonized CPI print rising to 2.8% year on year. That's against an estimate of 2.6%. So coming in ahead of expectations. And the point I was making earlier about the last mile is the hardest, and that seems to be the analogy that many policymakers are using when they talk about how difficult it is to make those final gains. So, sure, Spain has been successful, and the Eurozone has been successful, just like lots of other geographies, in bringing inflation down from those elevated levels. In Spain, it went up to more than 10% during 2022, but now we're back into sort of more everyday territory, I suppose, where inflation is just stubbornly higher, and the various authorities having to wrestle with that. This is no longer just the story of Russia's invasion into Ukraine and what that does to global energy prices. This is something that is now more hard-rooted. And interesting that Klaus Knott was talking about wage deals and the extent to which we're seeing wage deals out of step with where inflation really is right now.
Yeah, at the same time that the ECB is actually really diverging from the Federal Reserve as well. I would argue, I mean, it is slim pickings there, light volume, light liquidity, but maybe some of that reflect in the Spanish market as well. Your biggest index weights on the IBEX 35, for example, which is broadly lower, are Santander and BBVA. And we know that, of course, when that inflation data comes, that rates picture comes in, the banks are going to be crucially affected. So you are seeing two weights, maybe reflecting that.
And interesting, the euro not doing anything really on that. I mean, there's very few participants at their desks, perhaps, but certainly you could envisage a time where that kind of overshoot on inflation could have suggested some kind of questioning of how many cuts we'll get from the ECB. But it seems as if the focus on the ECB weakness in the growth story is just firmly entrenched right now.
And already you're seeing perhaps some of that kind of bid for the consumer staple showing up as well. If you're looking for a fundamental narrative, it might be there with Nestle as one of your top performers, higher by 0.4%. There's a lot to digest here. It is a little bit of a slow markets day, but lots to think about for 2025. Let's bring in an expert joining us around the open this morning. Salman Ahmed joins the program, Global Head of Macro and Strategic Asset Allocation over at Fidelity. Salman, a pleasure to have you on the program. Walk us through this 2025 story. It feels like we're ending the year with valuations being the chief concern for this equity rally to continue, specifically in the United States, but I would argue some of that sentiment in Europe as well. What does the stock market need for that to disappear, for the straw on the camel's back? What does that look like? It looks like we've lost Salman, but, maybe I'll put that question to you as well, because valuations is a big thing. We'll keep waiting for this policy story as well, but I feel like we end this year, or end every year, with the same conversation, that stocks have gone up, and we don't know if they'll continue, and then they do.
I remember some years where they didn't go up, Kriti. I'll just say that. But you're right that we started this year with expectations that stocks would go higher, but not by a huge amount, actually. And then we got to those levels. We got to the sort of Wall Street average expectation for stocks in the middle of January. Yeah. And then, Wall Street had to revisit, and the rest is history, perhaps. But the latter part of the year dominated by expectations and then the reality of a Trump trade and that filtering into market expectations. And that seems to be something that has been really preoccupying investors, along with the AI theme as well. So all of that certainly very much in the focus for markets. But interesting, you talk about valuations, and momentum trade has been something that's certainly driven 2023. 2024, and we're asking questions about whether that continues. And then there isn't such an easy read across from that theme into Europe, is there? Because European stocks have not done so well on the back of that momentum trade. So the idea that unwinds now perhaps has a lot less in it for Europe.
Yeah, and I think it also brings up this question of what is momentum driven in the United States, which is tech, which is the small caps. The momentum story in Europe, maybe see healthcare stocks, for example, Novo Nordisk. We had a guest earlier on the program talking about this kind of fear factor of some of the biggest kind of European equivalents of granolas, the sensational six, whatever you want to call them. They're the ones that are catching the bid. So if maybe momentum looks a little bit different in Europe as well. But I would argue the bond market story is a big one as well to factor in there. I think we've got Salman back. Let's bring him back into the program. Salman Ahmed, thank you for bearing with us. Global Head of Macro and Strategic Asset Allocation over at Fidelity. Salman, we just had a quick chat about the valuation story, but give us your view on what cracks valuations for stocks in 2025.
Sure, Kriti, and good morning to you and Anna. So basically, we are watching bond markets and real yields. If this inflation, risk story starts to play out in a much bigger way, then the valuations, which are quite, punchy, especially in the U.S., can start to get challenged. Our view is reflation in the U.S., strong nominal growth, both driven by real growth and some uptick in inflation. But if that higher inflation, if it's significant and it changes the Fed's outlook completely, then I think that's where our core risk or known unknown lies when it comes to the equity market as well.
So, Salman, something we've been talking a lot about has been this kind of inflation uptick. And we talked a lot about it in the States as kind of a reacceleration affecting the Fed story. You kind of spoke to it as well. In Europe, though, I think it's crucial that we talk about it from more of an energy perspective. It's the same conversation from 2 years ago. What is the risk of an inflation uptick in Europe, and how do you trade it?
The inflation uptick in Europe can be quite complicated because obviously growth profiles are are under significant more pressure than it is in the U.S. In fact, U.S. may see a reflationary boost on the back of Trump 2.0 policies. So that can put ECB in a very tough spot. But we think that the ECB will prioritize growth over inflation here. Mainly because there are some structural headwinds which Europe is facing, and then the tariff, which is still an uncertain, parameter when it comes to Europe, and it's going to be more purely economic-driven compared to, what you may see between U.S. and Canada or Mexico. That is the big unknown, and the offset here in Europe, in the absence of fiscal policy, is more monetary policy easing. So we think that growth will be more driving, a more bigger driving factor for ECB policy than inflation.
Yes, and Salman, we talked about this at the top of the last hour with our last guest, because we saw some comments from Klaus Knot at the ECB talking about how China might export some of its deflation to Europe next year. In particular, if President-elect Trump puts tariffs on products going from China into the United States, that some of those products might find their way to Europe. How much of a deflationary impulse will that provide to Europe, do you think?
I think it can be a significant one, but it will depend on the recalibration of supply chains. Because remember, the key economic power in the world is the U.S. consumer. So unless and until Europe or European consumer starts to spend money again, I think you will not get that offset. And if China is exporting to Europe and then Europe then is again exporting back to the U.S. consumer, then that tariff, transmission channel doesn't go away. But it can add or offset some of the inflationary impulse you may get from broader retaliation, if you will. So two key unknowns. Obviously, China is a positive deflationary factor, but then how much tariffs come into play, how much depreciation of euro comes into play to offset that will be important factors as well, not only China's deflation impulse.
Yeah, the role of the currency in there and the policy reflex, the policy response we see from European governments could also be important then, I suppose, Salman. So how much do you spend time thinking for 2025 about a divergent inflation story between the United States, which might see prices on the rise, perhaps because of tariffs or perhaps because of what's happening with underlying gas prices, as we were hearing from our guest in the last hour, versus Europe, where we might see deflation being exported from China into the European economy?
So certainly movements in the commodity prices will be important, but we think that the core inflation in Europe will face a downward trend, mainly because of the negative growth impulse if a significant tariff policy comes into play, and as you mentioned, anything which is coming through China, because China is a source of deflation to the world, apart from US if it puts tariffs on it. So that is going to be an important factor, but the growth profile for us is the worrying part, and we think that can offset some of this, marginal inflation impulses we may see coming through.
Salman, what is the hedge, though? I mean, the traditional hedges have always been, in the face of inflationary impulses, a basket of commodities or the bond market, U.S. treasuries, or even big tech, for example, all three of which are places right now where people aren't as bullish. What is the hedge?
So for broader inflation, we have to think about it in a different way, because this is not a cost push inflation we're talking about. This is policy induced in some cases. So extent of tariffs, extent of retaliation which comes through in that. So in our view, the currency is going to be an important hedge in response to any significant inflationary impulse which comes through from economic trade policy. The currency can be an offset factor. So certainly, I think a stronger dollar in this environment can help you. And then a combination with certain tail risk hedging through energy. We have not talked about geopolitics, but that's another open question. And we think that you have these cheap hedges available in energy markets if something goes completely wrong, and that is not our base case, but certainly from a portfolio design perspective, I think oil has a role to play as well in your broader hedging strategy. And then the steepening of the bond curve, I think that still remains our go-to place if our base case doesn't pan out.
Well, Salman, I want to go back to the currency picture as well, because there's an argument, I think I've seen it now from BlackRock, from Citi as well, that a cheap enough euro will be a tailwind to European assets, even in the face of ECB cuts, even in the face of kind of sluggish growth in the region. Do you buy that argument that a cheaper euro could, at the end of the day, be maybe the biggest asset for European assets to invest in, to attract that kind of international capital?
I think it will depend on the extent of the depreciation, which happens in response to the tariff policy. If your depreciation is controlled, then I see it as a tailwind. But if it becomes disruptive, then it is a problem, because a disruptive currency depreciation can be a symptom of broader issues. So I think it is not just the level, but also the pace of depreciation we have to be careful about, and how volatile that is. Because there will be sensitivity to how quickly a depreciation comes through. So if it is controlled, manageable in response to offsetting these changes in the trade policy, then I can see it as a tailwind, but not if it's disruptive.
Okay, so Salman, we'll watch the development of those trade tensions, and we'll see what that means for inflation and other policies, and for FX markets, as we've been discussing. Over in the United States, what are your expectations for how strong the US economy is in 2025? Many have been wrong-footed by how strong it remained during 2024.
So we are in the reflation camp. So we think there is upside risk to consensus growth in the U.S., driven by another easing of fiscal policy. Already, U.S. growth is tracking around 3%. It's a very strong economy. There is still savings left in the consumer for the consumer side of things, and the consumer is spending money. Labor market is slowing, but it is in level terms still a very strong labor market. So we think that those key drivers of strong U.S. economy still remain in place. What can offset that or derail that is either a very significant escalation in trade tensions and uncertainty, which starts to damage the capex cycle, and/or a significant immigration shock. I think those are the two risk factors of the U.S. economy. But otherwise, we do think that this is a reflation setup for U.S. Maybe at the expense of other major economies as well.
All right, Salman Ahmed, Global Head of Macro and Strategic Asset Allocation over at Fidelity, joining us this morning. We thank you so much. In the meantime, let's get a quick check on the Core 6. I'm going to do my best to have my Guy Johnson impression pulled out here. When we look at some of the big numbers, you want to keep an eye on the likes of LVMH. You want to keep an eye on the likes of Nestle, for example. LVMH taking a hit down about 0.5%. Nestle is your sole outperformer amid the Core 6, higher by about 0.2%. Some could make the argument that that is a little bit of an inflation play, as maybe we get some of the inflation numbers around Europe taking a little bit higher. Spain, of course, a great example of that this morning. Novo Nordisk continuing its slide down about 2% this morning. Ferrari and ASML also on the back foot, Anna.
Yeah, Novo Nordisk well off those highs that we saw in June of this year, over 1,000 Danish kroner per share, then now down at 624. Coming up on the programme, the top 50 companies to keep an eye on as we head into the new year. We'll discuss where traders are hedging their bets and the critical themes connecting some of the ones to watch in 2025. This is Bloomberg.
Welcome back to the opening trade. We're about 19 minutes into today's session. Seeing red on the screen, perhaps people just taking some money off of the table as we go into the last trading day of the year. And for some, the last trading day is today. Germany, for example, closed as I believe the U.S. is a partial day. A lot going on. Nevertheless, red on your screen, underperformance in the Stock 600 relative to all of the other indices. But let's go ahead and look ahead to 2025. Investors weighing up which firms to back in the new year. Bloomberg Intelligence Director of Research, Tim Craighead, has been breaking down the critical themes, connecting some of the top companies to keep an eye on, and joins us this morning. So you and your team have published a list of about 50 companies or so, 50 companies to watch. Give us some context about the list to begin with, and then we'll dive into the details.
Yeah, sounds great. So this is an annual project that we work on, and essentially what we're looking for are companies that have got something notable coming up on in the new year, and catalysts to change the market's mindset around to where we're thinking the prospects are going. We use our broad list of focus ideas, which essentially are differentiated ideas with catalysts as a base. It's always nicely diversified across sectors, across regions. In this case, about 50% of the companies that we've got on the 50 are focused in the U.S. About 30% are in Europe. Another 20% are in Asia. We've got 40 ideas that are constructive ideas, 10 where we see some risk to consensus. So well balanced, interesting, and you can certainly break it down into different buckets to make it more digestible.
Yes, let's do that, shall we, Tim? Because I think that's useful. So in terms of the European names, focusing in on those, you mentioned that these ideas come from lots of geographies and lots of different themes. But focusing in on Europe and picking out a couple of themes that do seem to feature quite heavily in Europe. One is innovation and energy transition. Also a part of the mix here. So can you tell us a bit about those themes and how they play out for Europe?
Yeah, absolutely. So, you think new products, that's always kind of one of the sexy elements to be looking at and sort of the fun part of investing. And there are a couple from a European perspective that I think are worth noting in 2025. Porsche. Who doesn't like Porsche? Importantly, there are 5 new cars that are in process of coming through. Some have been launched, some are to be launched, but the hybrid 911, you've got a new version of the Cayenne, among others. And, this is a pretty interesting story from the standpoint of, there's an energy transition EV story behind Porsche, but the core is still combustion.
Yeah.
And to the degree that EVs seem to be taking a little longer, a little bit of a pause, it's actually playing into Porsche's profit margins. They got new products and that element. Go into some others. AstraZeneca, a host of new molecules that will be coming through with new data sets in 2025. Respiratory and cancer being, two big categories. And on the energy transition front, a couple of things. Subsea 7, which I'm guessing a number of people won't have heard of this company. It's marine construction. Historically, what they make are oil and gas rigs and things along those lines. But to the degree that there's a lot of offshore wind that's being designed and destined, they're there to construct that. And RWE, not long ago had bought Con Ed Clean Energy in the U.S., expanded their U.S. footprint significantly, and that's all clean energy oriented.
It's funny that you're talking about innovation to some extent in a region where it feels like falling interest rates, the economic story is such an Achilles heel of the region. Are there other companies that are maybe a little bit more exposed or work as hedges towards those themes?
Yeah, well, it's interesting because if I look at last year's list, there was more of an economic concern, especially from a European perspective, that coalesced through elements of the companies that we had selected. This year, it's reversed. We've got more positive economic stories in Europe, which I think are worth noting. Airbus is a global economic story. It's one of supply chain coming back into fold that allows them to boost production of A320s. We think that there's a lot to that. And Boeing continues to have issues, even if there's a little bit more recent positive news. Adecco. Employment has suffered. We think that there's a story with lower central bank rates in the U.S. across Europe for employment to pick back up after a few years of subpar activity. Got a couple of housing stories that play into Europe. Persimmon here in the U.K. The whole story about U.K. doing better about planning and getting new sites freed up and things along those lines are quite constructive. And Signify, another name that isn't necessarily household, but actually really is, world's largest lighting manufacturer. This is the company that came out of Philips.
Yeah.
And, if we've got better housing activity with lower interest rates in the U.S. and across Europe, they stand to benefit. So there are a few there like that to play with.
So that's a way that policy is going to impact on certain sectors, Tim, very clearly next year. And that seems foreseeable. I wonder how much you integrate the expectations of what President-elect Trump will mean into your thinking about some of these companies, because I suppose it's possible to look at some of the names and say, well, there might be tariffs on this business and then things might change. I mean, just conceptually, when approaching this, have you sort of parked possible policy initiatives from President-elect Trump, or have you tried to incorporate what we can know?
Yeah, I mean, broadly across the buckets, if you think about it that perspective, as well as individual bottom-up companies, we're certainly keeping that in mind. But, as controversial as President-elect Trump is on lots of different fronts, you look at the U.S. economy, look at what's going on with consumer spending, look at what's going on with a lot of business sentiment.
Yeah.
A bigger deal is about clarity.
Yeah.
And, there was so much uncertainty going into the election. Either way, it's a better story as we look into 2025.
That's interesting. A nice place to leave the conversation. Thank you very much for joining us, Tim. Tim Craighead, Bloomberg Intelligence Director of Research. Coming up on the programme, a flurry of deal-making sees European banks attract the most deal activity since 2020. We'll discuss if the surge in M&A is likely to continue into next year. That conversation next. This is Bloomberg.
This is the opening trade. We're about 30 minutes into today's session. Seeing red on the screen across the board. Underperformance actually in the UK now. Looks like the selling is accelerating. They're down by about 0.4% as I see it on my screen. But it's a similar story across all of the major indices. France, Germany, Spain, wherever you look, people are selling. And I just feel like it's a little bit of that maybe New Year's Eve malaise.
Yes, indeed. And for some markets, as we've said a number of times, this is the end of the year, isn't it? This is the last day of trading, certainly in Japan and Germany, Switzerland, some of the Nordic markets, that is the case, but others will be back here tomorrow. Now, let's talk about the banking sector a little. Higher for longer interest rates have lifted the market capitalisation of major European banks by almost 500 billion euros since the lows recorded just over 2 years ago. But the rally is at risk of stalling amid monetary easing and weak economic conditions across the continent. Joining us now to discuss the outlook for European banks in 2025 is Philip Richards, Senior Bank Analyst at Bloomberg Intelligence. And Philip, thank you so much for being with us today. So European banks, they've rallied almost 25% year to date. A lot of that, I am guessing, has been driven by changing expectations around interest rates. And what can you tell us about that drive, that push higher in bank stocks?
Yeah, good morning, Anna. I think a lot of you mentioned about the 80% rally in the sector over 2 years. I think a lot of that has been driven by that real surge in interest rates, and that's really driven the earnings drivers. There's another additional benefit for the banks as well. Their capital positions are very strong. Therefore, that has led to an increase in share buybacks and also dividends to a degree. But really key, and what we've seen this year, the return of M&A in the sector, obviously led by UniCredit in terms of their approaches towards Commerzbank and Banco BPM. So a number of factors there all contributing to that big rally in the sector.
Well, Philip, walk us through the kind of combination of that consolidation story, but also the interest rate story as well. Does one affect the other?
Well, it certainly does. But I think the risk is also getting bigger in terms of looking for next year. Because we talk about all these benefits, these positives for next year. So in terms of the interest rate hikes and the boost that's had to earnings. But the fact is, obviously now we expect interest rates to decline. Also, economic growth conditions across Europe are very weak. Also, something called cost of risk is your losses in your loans have been very, very low, therefore are likely to move higher. So putting all that together, you see the revenue pressures are getting harder, tougher, and therefore might come down. Cost of risk is going up, and therefore the earnings of the banks are getting squeezed on those sides. And therefore that's what's leading a lot of these banks to look, well, if we can't grow earnings organically, then maybe we have to use that big surplus capital balances that I mentioned earlier to actually acquire other banks.
Yes, and M&A is certainly a theme we'll get onto. In terms of the UK banks and where expectations are around interest rates, are UK banks better positioned then, Philip, than European peers, given we have lower expectations of rate cuts in the UK?
Yeah, well, that's one of the anomalies, one of the good things about the persistent inflation we've had in the UK. Therefore, the Bank of England has not been able to cut rates quite as aggressively as we've seen across the Eurozone. And that's expected to continue next year based on market rates. And therefore, if you've got higher for longer rates, staying up about 4% over 12 months, whereas it was expected to come down to actually below 2% now across the Eurozone. And that's going to be a boost for the banks. So that helps their margin. So yes, there is some sort of differential between the UK banks now being better positioned because of those higher rates expected.
Philip, you flagged that several banks, including SocGen, UniCredit, Commerzbank, have entered the, quote, zero sell club of broker recommendations. Can you just walk us through that?
Yeah, well, it's a bit of an anomaly. We talked about that massive rally in the sector. So the sector up 80% over 2 years. At the same time, you look at the valuation, so the prices versus the earnings, they're actually at very low levels, actually the lowest levels, essentially at about 7 times the sector, since basically the great financial crisis and back in 2008. What's basically telling us, on the one side, you've got the buy side, who are very skeptical still on the banks, and giving those very low valuations. And then on the flip side, as we show here, if you look at the broker valuations, they're actually being much more optimistic. To say zero sells across all brokers for a number of those stocks we're showing there. So there's a bit of a dichotomy, a difference between the two sectors.
Well, certainly something we're going to be keeping very, very close on.
Philip Richards. The earnings risk we're seeing for the sector. We see the PE is very, very low, but that's because a lot of the degree people are unsure about what the earnings and where they're going. If those earnings are going to come down, then actually maybe the valuation is a bit higher.
It's certainly something we're going to be keeping a close eye on. Philip Richards, a senior banks analyst over at Bloomberg Intelligence, joining us this morning. I think we've covered quite the gambit with just you. We're going to continue the conversation on that European story. As Philip mentioned, European banks have seen a surge in M&A deals in 2024 that topped $41.5 billion. Now, financial companies have served up the biggest slice of European M&A among sectors this year, accounting for, get this, 17% of the total. Joining us now is Simon Samuels, partner at Veritum Partners, an advisory firm that focuses on the financial services sector. Simon, a pleasure to have you on the program. Good morning from London. We talk a lot about this M&A story and kind of how it's coming as a function of maybe these excess profits, big balance sheets from some of these European banks. in the face of a falling interest rate environment, does this continue in 2025?
Yeah, good morning, Kriti. Well, I think bottom line is yes. I always think when it comes to issues of M&A, there's probably three parties who are important to think about here in terms of their desire for M&A. There's the bank managements themselves, and as a general rule, I think bank managements like to get bigger and instinctively are quite keen on buying things. There's regulators, and certainly in the Eurozone in particular, I think unusually the regulators are very, very keen on consolidation across the Eurozone. So rather than the typical regulatory concerns, there's almost regulatory cheerleading going on. The final group, though, are shareholders, and I think shareholders tend to be a lot more skeptical about M&A, particularly when it's cross-border M&A. There's been a long history in this industry of banks promising significant synergies from cross-border M&A, either within Europe or elsewhere in the world, and generally failing to deliver. So I think there is still skepticism among investors, but I think there's a keenness by management and almost an encouraging attitude, certainly within the Eurozone, but by regulators.
Well, Simon, I think it's an interesting point that you bring up from the shareholder perspective, because one of the big themes of this year has been these massive share buybacks by European banks in a way that I don't think history has really seen the level from this. But it's also funded a lot of these consolidation offers. BBVA is just one example. We've seen this in several others, where part of the deal offer is stocks, even though relative to its global peers, European banks have underperformed. How do they make up for that? Does that just mean this kind of wave of consolidation falls apart the minute the stock sells off?
Well, I mean, valuations still, certainly relative to history, are still very low in the European bank sector. Yes, they've rallied a lot from their all-time lows a year and a half, 2 years ago, but still in absolute terms, they still look very attractive. I think the period of significant capital generation and capital return is likely coming to an end. Essentially, most banks in Europe have got their capital ratios quite close to or trending towards their target levels. There's also, and this is encouraging, but it also has impacts for capital return. There's some early signs of volume growth picking up across the European economies, and more loan growth means that banks need to allocate more capital to fund the growth of the business rather than giving it back to shareholders. So I think even without the M&A dynamic, I think the period of extraordinary capital returns, as you describe it, Kriti, I think is likely to come to an end anyway. But I think more M&A will likely accelerate that as well.
Simon, good morning. Can I ask you a little more about what you said about regulators, one of the three sort of players in these M&A sagas? And you said regulators are actually quite keen on the idea of M&A. We hear quite a lot of resistance from some quarters to attempts to bring together, for example, Italian and German banks right now. I suppose you don't want to confuse governments and the existing shareholders, in the case of Commerzbank, with regulators. But where do you specifically see the positivity from regulators cutting through? Where is that going to make a difference?
Yeah, absolutely. So I think, first of all, you're absolutely right. I think regulators are very different politicians. And so regulators might have one view on the keenness for European bank consolidation. As we've seen in the case of UniCredit and Commerzbank, German politicians clearly have a very different view. I think it's been driven by a couple of factors. One is, I think the regulators are very keen to force home banking union. And one of the ways to try and accelerate the move towards banking union would be to create more certainly pan-Eurozone, but pan-European banking conglomerate. So I think that's one factor. I think a second factor that I think regulators are very aware of is IT requirements to maintain competitiveness. So, for example, just to give you a relevant or an interesting statistic, JP Morgan, Citi, and Bank of America, the three largest banks in the United States, in aggregate spend the same on IT as the entire European bank sector. And I think regulators are very aware that there is significant IT economies of scale available to banks, and they are concerned, I think, that the US banks in particular are going to be the big beneficiaries of that. And so I think there is a kind of a further desire among regulators to ensure that European banks are kind of fit for future purpose, if you like, particularly when in the face of significant IT spends.
Yes, and Simon, just picking up on the comparison across the Atlantic, I think is interesting because if you are looking to put more money into investing in the banking sector, is there a risk for European banks in 2025 that a lot of that money goes stateside if rates are going to stay higher there because the growth threat isn't there to the extent it is in Europe, and if the growth incentives are in the United States, is it a risk for European banks that they struggle to attract that capital across the Atlantic?
Bottom line, yes. And actually, similar to Phil Richards, your previous speaker, was saying, part of the reason the UK banks are a bit more attractive than the European banks is because there is an expectation that interest rates will stay higher in the UK for longer. And that extends further to the US. So there is, as you rightly point out, Anna, an expectation US rates post-Trump will be higher than in Europe. And so I think that's definitely the case, that US banks have got that advantage. There's another factor as well, and I think it's a really important issue for investors. There are only 2 banks in Europe who have a market cap in excess of $100 billion. There are an increasing number of banks around the world outside of Europe with that size market cap, and global investors need massive market caps to be interested. And so I think there is that other aspect, which is in turn, by the way, is fueling consolidation, that European banks need to become a lot bigger and therefore a lot more relevant for global investors.
Simon, thank you very much. We appreciate your time. Thank you for joining us. Simon Samuels, partner at Veritum Partners. Let's return to our top story this morning. Former US President Jimmy Carter has died at the age of 100 at his home in Plains, Georgia. His term in the White House was marked by significant achievements, including brokering a peace accord between Israel and Egypt, as well as economic turmoil at home. Bloomberg's David Weston takes a look back at his life.
President Carter came to office in the wake of Watergate and Vietnam with a commitment to right the ship of state.
President Carter brought back to government honesty, integrity, and faith in government. He ran as a candidate on a government as good as its people, and he truly did deliver that.
I think President Carter in many ways was ahead of his time in terms of his emphasis, for example, on human rights, in terms of his thinking about alternative energy, in terms of his role in the Middle East peace agreements that he put together. And we all know that his ex-presidency, which has been such a long one, has been graced by remarkable contributions to humanity by former President Carter. I think right now, he is seen very favorably. I'm really happy to see that because he's a very special man.
One of President Carter's biggest challenges was energy in the face of the second Arab oil embargo.
Well, he was president during a very challenging time. As you recall, there was the oil embargo, which drove oil prices up dramatically. That became a catalyst for the highest inflation that we had really since the war, and probably even before that. And so he had to take some very tough fiscal measures. He did appoint Paul Volcker, who, by very much tightening monetary policy, caused a recession, which certainly was not an easy thing for President Carter to run through.
He was the first person to talk about energy and how we had to start looking at renewable energy plans and how our country could invest and incentivize in that area. And I don't know if you remember, but he had a solar panel on the White House, which when he left, President Reagan took down. But he also had fuel mileage standards and, really realized, I think, way before anybody else that we had to start thinking about what climate and what it was doing to our planet.
But as influential as Jimmy Carter was as president, he will be remembered every bit as much for what he did after he left office.
The thing, though, that I think is absolutely most notable about President Carter is we can all debate the relative merits of any individual president's term. But I think it's inarguable that President Carter is the single most impressive, most successful, and most to be admired ex-president in the history of our nation. This is a man who took the responsibilities of being a visible public figure incredibly seriously and was a role model to all of us.
Welcome back to the opening trade. 8:48 here in London, 48 minutes into what is for some markets the last trading day of the year, and for others it is not. But we see some red on the screen this morning. We're down by around 0.4% on Euro Stoxx 600 this morning. Let's put markets aside, shall we, as many people probably are doing just that in these final days of the year. As 2024 draws to a close, the question on everyone's mind is, where should I go in 2025? So we're here to answer that question, and we have brought in Bloomberg's Kate Crader, something of an expert in travelling and enjoying herself globally. So thank you very much for coming in, Kate, to see us. So we could go global in this conversation, but we've decided to start a little closer to home first off, and that is around London. What is exciting you about London in 2025?
So here's the thing that's great about London this year and also next year is the Elizabeth line, which is only, believe it. I mean,
love your enthusiasm for some infrastructure.
About the tube. Yeah. I know. Well, just it's kind of an amazing tube line. It started, as you know, in 2022, and it already has become the busiest line. It carries about 4.3 million passengers or more than that a week, but it also happens to be the tube that you're going to want to take to go to all the cool restaurants next year, starting with Bishopsgate, so that's Liverpool Street Station. Gordon Ramsay, one of the world's most famous and very tempestuous chef, is opening 5 concepts at 22 Bishopsgate, and they're up in the sky. He has a restaurant called Lucky Cat that specializes in sushi and Asian food. It's going to be on the 60th floor, which is going to make it the highest dining room in London. He's also going to do a cooking school, and it's TBD whether he teaches there and will scream at people or, whether the
and whether
instructors...
we can watch.
Yeah, exactly.
Do we get to watch the cookery school?
Don't you
that
want to go?
Interesting spectator sport.
I think it would be worth going and just watch what happens
just
next.
Screamed out for the experience.
I thought for a moment
that's how I feel. Kind of.
It's part of the deal. I thought for a moment Kate was going to tell us that the best thing to do in London is to spend your time on the Elizabeth line. But I'm pleased that she's there is food at the end of it.
There is food.
Maybe the next step is the commute on the Elizabeth line will be catered as well.
Oh my gosh, what a great idea.
You should pitch it to Gordon Ramsay.
I should, exactly. Well, there's a couple other big deal restaurants coming sometime in the summer, and that's to the Chancery Rosewood, which is a huge big deal hotel that's opening in the former U.S. Embassy. So like the Eagle, the Signature Eagle will be looking down on hotel guests, but 2 huge, I can't say how big they are. One is Richard Caring, who you know from the Ivy, is bringing back Le Caprice, the storied London restaurant. And then Carbone, which is arguably the biggest deal U.S. restaurant now. It's come to epitomize red sauce, which is all of a sudden become, not all of a sudden, but it's a power dining move now to have red sauce pasta. And the major food group is making their UK debut also.
Wait, when is that? The Carbone obsession in New York. I recently experienced it for the very first time after living in New York for 5 years, and it was amazing. I mean, totally lived up to the hype, but will it still be as hard to access in London as maybe in New York?
I think certainly at the onset it will, because everybody wants to go. They haven't been here before. They're going to be serving all their signatures like veal parm and spicy vodka rigatoni, and you know what? I think I would say it's not going to be easy.
So what else in New York do we watch for then? Let's go a little further afield than London.
Well, that's a good question. So the Upper East Side has traditionally been one of New York's most boring neighborhoods. It's not where you would go to have any fun or to eat anything interesting, that's for sure. And that's changed. It's kind of amazing. As a New Yorker, I'm kind of heartened to say that, because you want every neighborhood to have its moment. And that's definitely happening in the Upper East Side now. A place called Le Vaudor, which used to be, which was a very old school, famous, not very good French restaurant where Anthony Bourdain would hang out there and smoke in the dining room even after you weren't allowed to, so it definitely had its bonuses, but the food wasn't one of them. And it's been taken over, and now it's a fantastic restaurant. A little further uptown, Chez Fifi just opened, also French, from the Fulquier brothers, and they're known in New York for having sushi nas, which is one of the very expensive, I think it's $550 a person, $550, just to order your sushi. But they've opened a more casual bistro called Chez Fifi. It's named for their mother. It has escargot, and then the bar scene's great. Bemelman's Bar has made a name for itself, and that's still bringing people in. The Frick is reopening, one of New York's great restaurants. I mean, did I say restaurant? It's a museum.
Okay.
It's a museum, but it will have a cafe. Is reopening on Fifth Avenue after a couple years of renovation.
So everything is a restaurant these days.
Yes, thank you.
It sounds great. I hear you are a White Lotus watcher.
I am a White Lotus watcher, and in fact, it's as my fellow White Lotus watchers will know, it's coming back to the screens on February 16th, and it's going to be set in Bangkok. And as you know, for what it did for Hawaii and Italy, southern Italy, it's in Sicily, it's going to probably blow, make Bangkok even more popular than it's been. Like, Bangkok's also had a transformation. It used to be a backpacker haven, and you would go for cheap street food. And now it's got these fancy restaurants and these super glitzy hotels. The Mandarin Oriental has been around for a while, but it just had a $90 million renovation. I think there's 2 pools facing the waterfront. And White Lotus, to bring it back, was filmed. Some scenes were filmed there.
Okay. So, I mean, it's amazing, isn't it, that these places that you'd think their reputations speak for themselves, the part of Italy that White Lotus was filmed in, or in Hawaii, these places can still get more of a boost from some of these shows. Incredible.
Yeah. Kate, there's a long list here, and our viewers should definitely go and check it out. 25 places to watch. But if you could pick one, where would you go?
I love that question. I would say, it's such a great list. It goes from the Seychelles, to Lexington, Kentucky. But I would say Japan. We spotlighted Japan, and it's a great time to go. The exchange rate is super favorable.
If you're spending dollars in particular. But if you're spending other things also, not so bad.
It's just such these fantastic hotels are opening in Kyoto. The Capella, which won Best Hotel of the Year in Bangkok, is opening in Kyoto. Osaka has a Four Seasons coming. So I think no matter where you go, it's going to be a terrific adventure.
All right. Well, we look forward to hearing where your travel takes you in 2025. Kate Crater, Happy New Year. Thank you for joining us around the table this morning. She had all the fun stuff. We got to get back to what we thought would be maybe a little bit boring week, but there's plenty of data to look ahead to for this week on the economic front. On Monday, today, we do get the Dallas Fed manufacturing activity and pending home sales over in the States. On Tuesday, the focus shifts firmly over to China. PMI data out of there, but then really gearing up towards the new year. We are going to have most markets closed around the world on Wednesday, but then on Thursday, back on the economic front, manufacturing PMI data from China and the United States. And then the honor goes to Richmond Fed President Thomas Barkin, who gets to speak on Friday.
I like how we're very serious people, Kriti, and we managed to go from Kate Crater taking us wonderfully around the world in food and travel back to the data. So, we're confident in
check the boxes today.
Yeah, we're confident in our enthusiasm for the data this week, even though there isn't that much of it, and it is New Year's Day on Wednesday. So we won't be here. None of us will be here on Wednesday. Markets will be closed. Yeah. Some markets closed tomorrow as well. Japan is closed tomorrow. Germany, Switzerland, some of the Nordics are closed tomorrow. So for them, this will be the last trading day of the week, of the year, sorry. But for many markets, there is another day to go, and we will be back tomorrow with that. I'll be back with the Pulse in just a moment. And coming up on the programme, we'll be speaking to Runa Alam, Developments Partner, International co-founding partner and CEO, on what we can expect from markets in 2025. That conversation a little later this morning, 11:45 a.m. This is Bloomberg.